you did in April, I believe, a $4 billion bond in the US.
Yeah, we did.
And you turned to that market, I think, as the first unsecured bond market you turned to. Now, I would just be interested in your thoughts on how the dollar bond market and the euro bond market, and indeed others, but those are the two main ones, have performed relative to each other during the crisis.
Yeah, I would like to add China as well to this one, just to make the picture clear. But yeah, you're right. We return to the 144A market. I think what we need to distinguish also in all these discussions we have had during the last session and even here during this call now, we have to distinguish between what is ordinary standard financing for the company and what is triggered, let's say, through stress and whatsoever external factors. If you would look into our financing patterns, we do a 144A every March, April, every year. So this is a routine return to the market. The market itself is very receptive, at least for us, and the US market is anyhow the most liquid market in the world. And as such, we also decided to return to this market even this year, even though we saw the spread widening. Yeah, you could argue, oh, you went in a situation where spreads were higher than before, and it was. But again, for us, a relationship call to our investors. We have a regular investor relations meeting. We know what they look for, what they need. And as long as we provide them with a reliable relationship and they need the paper also for their books, we are fully convinced that this is the right way to do business with each other. So that's the reason why we decided, even in some, you could argue, not the most favorable spread situation that time, to access that market. So the US market was, by the way, also the first market or the market that kept liquid, I would say, if you would just deduct some volatile bad days out of that equation. But the US market, in my opinion, remained pretty liquid during the entire time. The euro market has picked up since a couple of weeks already. Spread tightening has occurred as well. So I would say I would not consider none of those two markets being really dysfunctional through the COVID crisis. The market that works the best, and therefore I mentioned China at the very beginning, is China. In China, you see nothing. You just continue business as usual. And we placed a Panda bond in our regular funding program, and we actually achieved the most cost-efficient Panda bond ever issued by the BMW Group in this situation. But this is really China-specific, whereas spreads, as said, in the developed markets, Europe and US, went up. In China, we achieved a very tight transaction.
This crisis, the coronavirus crisis that has affected markets so strongly, has clearly put a great emphasis on the cash companies have and whether they have enough. So I'd be interested in your thoughts on whether you think companies have been carrying enough cash.
All right, yeah. If we look back to the global financial crisis, a good amount of companies then afterwards did focus on deleveraging their balance sheet. So we've seen that trend continuing even until the COVID crisis kicked in. And in addition, we have seen a lot of liquidity buffers build up. And if you would look into the balance sheets, you see a much higher liquidity buffer compared to the global financial crisis. Nevertheless, I believe if you want to run and have a successful liquidity management in your company, it's about being prepared for crisis scenarios. And this is just much more than having cash on hands, because carrying liquidity on the balance sheet is one thing. The next question you would have to ask yourself, especially as we are a global company, is what you see is what you get, because it could be trapped. Yeah, you see a lot of cash on your balance sheet and you don't know, can you make it available for yourself? So make sure you have what you see is what you get. We have that within our structures, so how we have set up our liquidity steering within BMW Group. Liquidity management is not separate in the sense of liquidity risk management, steering, or however you could call it. It is actually embedded in the overall corporate finance strategy, and this is where it belongs. I'm fully convinced of this one. And as I mentioned earlier, it's not only about carrying cash on the balance sheet and make sure that what you see is what you get. It is about how you do your financing all over. And to give you the example for the BMW Group, how we do it, first of all, we look into our maturity profile. So you make sure if a crisis kicks in at any time, don't get surprised by a heretic maturity profile. It's about a well-defined usage of available financing instruments. This is about diversification of availability of instruments. This also means keep your documentation at heart. You need to be ready to execute and not just restart negotiating documents when times get tough. And what you also need to do is you need to maintain instruments and markets during good times, although they may at that very moment not be the most cost efficient. You need to keep the relationship with your investors healthy and ongoing. And this is what we management. So this is a vital part of liquidity risk management. Think about the product commercial paper. I always call it the sweet poison. It is nice and cheap money in good times, but it really makes you running into refinancing stress if things kick in. So make sure you use commercial paper wisely and not as a, how should I say, a transforming instrument to have a very short and cheap funding to finance longer dated assets. This is something we don't do. So we keep this very, very rare in the utilization in times of in good times.